Hey guys, welcome back. So today we're going to talk about what is self-directed investing. First off, we're going to talk about what it is. Second, we're going to talk about what different account types are available for this type of investing. And third, we're going to talk about what can we do with it. Let's get started. So, what is self-directed investing? First, it allows you to trade directly without a middleman making decisions for you or guiding you for a commission. Also, thanks to Robinhood, the original free trades brokerage. Now we also have many other brokerages going that route of $0 trades, such as Fidelity, Schwab, Merrill Edge, and many more. And I think more is going to keep switching over. I also believe that self-directed brokerage accounts will adapt to the new standard of free trades within probably another year or so. So it's, just expect pretty much free trades. And taking that into consideration, as we looked at in our last video uh, about the compounding power, we saw how a very small regular commission charge of 2% is just terrible for long-term returns. The primary way to avoid this is through a self-directed account. And once you open a self-directed account and have direct access to the market, you then have the choice to do the research and the work to pick individual stocks to outperform the market or choose an index fund that follows the market for a very small commission of, let's say, 0.03% on the VOO S&P 500 index fund as an example. So you have direct access to the market. You have no management fees by default or very low management fees through an ETF or index fund. And you have full control of your portfolio because you can choose individual stocks or index funds or ETFs or whatever you're looking for. And the index fund route is becoming extremely popular because it is a very passive way to build wealth in the market. However, if you want to outperform the market, you would need to put a lot of time and effort down to study different businesses and figure out which are great investments and where many aspects align. I'll do a video in the future on choosing individual stocks, but that's the approach of really putting in a lot of effort in versus the passive index fund route. The reward for putting in the time, though, is increased returns because the market average per year is about 8 to 12%. So if you're looking at index fund, you're pretty much going to match that market and do the 8 to 12% regular. But as an individual stock picker, your return is potential is higher. Usually I see 20% average for stock pickers, myself included. You might say that, you know, this is, maybe an 8 to 12% beat on the market, and it's a lot of work. So it's really, year to year, you're looking at a very small difference. However, the key is, as we saw before, a 2% reduction can be devastating. So imagine how incredible just an 8% market beat is over the long term with compounding. All right, another thing to take a look at, different types of accounts. So you have regular self-directed account, self-directed IRA, you have self-directed Roth IRA, self-directed HSA. So regular self-directed, that one is taxed normally. Short-term trades or long-term trades just taxed in the year that you sell. That is what it is. Depending on if you hold it for 12 months or longer, it would be long-term capital gains. If you hold it for less than 12 months, it would be short-term. But this is taxed now at the end when you sell. The self-directed IRA is a deferral of tax, so you're going to be taxed when you take out the gains and take out the money, but you do put money in pre-taxed, just like a 401k. And this one you can open up yourself and put in money yourself. Roth IRA is you put after-tax money in, but any profit you make, you don't pay any taxes on it. And you can only take money out when you retire, but you don't pay any taxes because it's after-tax money in, gains are yours. HSA is um, any gains that you gain here if you can only use this money, and it's also pre-taxed, but you can only use this money for health uh, expenses, and it can be very tricky to use that because it does limit what you can use it for. However, it is advantageous if you have an extra cash to use this method. Through a company, you can have self-directed 401ks, but usually companies don't have self-directed 401ks. But if your company does offer self-directed 401k, that is awesome. Self-directed Roth IRA, Roth 401ks, same idea as the IRA and Roth IRA, just larger contribution limits per year. And a self-directed SEP or SEP IRA is for self-employed individuals. So if you're self-employed, you can have one of these on your company, as well as probably a self-directed 401k or Roth 401k. And many of these can be opened up with Fidelity, Merrill Edge, or for pretty much just any regular brokerage account you have. Many of these can. Now, one thing is, for example, if you look at a Robinhood, you're looking at this regular self-directed. And if you're looking at Webull, you're also looking at this regular self-directed. And actually, in the link, I will have linked for Webull and Robinhood if you are interested in some free shares. I get a free share, and you guys get a free share if you sign up. Um, if you guys are interested, it's just free money. But so that is the different types of accounts and what self-directed is and the benefits that you can use it for. But let's dive in even deeper. What you can do with a self-directed account, more specifically, you can do the individual stock picking, which I spoke about. There are 3 different methods. You have growth investing, dividend investing, and value investing. Really quick, growth investing, you're looking for massive growth. Usually this is can be interpreted as like speculative or just recently speculative, more now stable, but still huge high growth in the future. You're not getting dividend payouts, that type of thing. Dividend investing is fully for those nice juicy dividends, and if there's growth, it's just a bonus on top. And value is you're getting a company for undervalue, and you're looking for it to go back to fair value, and then you make your profit that way. And you can also have some dividends on those. Index fund investing is literally just pick the index you want to follow, S&P 500 or Dow or NASDAQ or whatever, and that is what you're following. Any style of investing that you choose or create can be done with a self-directed account because you are directing it. You choose whatever you want. You can mix and match these methods. You can do whatever you want. It's incredible. If you want more videos in the future about these specifics and what dive into each of these, let me know down in the description and we can do that in future videos. So thank you guys for watching. I hope this video was very helpful, and if you did like this video, don't forget to click the like button down below, because that does definitely help me out on YouTube. And stay tuned for next video. Please subscribe and hit the bell so you're notified, and I'll see you guys next time.